Welcome back to the deep dive. So our mission today, well, it's a pretty deep look into the Q3 2025 results from one of the big integrated energy players. We've gone through the reports, the calls, and there's this major paradox we need to unpack for you.
Yeah, it's pretty striking, isn't it?
Yeah.
I mean, basic market logic says if Brent crude drops hard and it fell, over $10 a barrel year on year,
Yeah,
profit should follow.
exactly. Should take a serious hit, but that's just not what we saw here. Their adjusted net income held steady, $4 billion. And, here's the kicker. Operating cash flow actually increased by 4% to $7.1 billion. I mean, that's resilient, sure, but how do you manage that when the main commodity price is, well, falling off a cliff?
It really comes down to their strategy, what they call the two-pillar strategy. They basically built in some shock absorbers against that price volatility.
Pillars.
Yeah,
Okay.
pillar one, strong high-margin hydrocarbon production growth, really key.
Yeah.
And pillar two is about maximizing market capture and, flexibility downstream in the integrated segments.
Yeah. Okay, so that's what we're diving into. The mechanics of that resilience. We'll look at how these new barrels are kind of offsetting the lower prices, the surprising strength in refining, what they're doing in LNG and power, and yeah, this big push into digital.
Sounds like a plan.
Right. Let's start with pillar one then, the upstream side. That seems to be the main engine here, delivering what they keep calling accretive production growth.
Oh, definitely. The growth was pretty significant. Hydrocarbon production up more than 4% year on year. That's actually their highest growth quarter so far in 2025.
4%. Okay. And they expect that to continue.
Yep. The outlook for Q4 is basically the same, 4% or maybe even a bit more for upstream production. They're not slowing down there.
Okay, but let's pause on that word. Accretive. For you listening, that doesn't just mean like more oil, right? It implies higher quality, more valuable oil.
Exactly. It's not just volume, it's value. And that value boost is coming from these newer projects they've brought online recently.
Which ones are we talking about?
Well, think Merrill Fields in Brazil, some deep water stuff in the U.S., Tyra over in Denmark, Phoenix in Argentina, those kinds of projects. And the crucial part is this. The average cash flow margin on barrels from these new projects is roughly twice what they get from their older base portfolio.
Wow, twice the margin.
Wow.
That's huge leverage. But hang on, isn't just relying on these, high margin newer fields just sort of kicking the can down the road on lower Brent prices? What happens when these wells mature?
That's definitely the longer-term question, yeah.
Yeah.
But for right now, I mean, in Q3, that leverage really paid off. Those new barrels, they brought in about $400 million extra cash flow compared to last year.
$400 million just from the new stuff.
Right. And here's the key takeaway for you. That $400 million effectively absorbed the cash flow hit, equivalent to Brent prices dropping by $6 a barrel. It literally acted like a subsidy for the rest of their business against the weak prices.
Okay, that makes sense. And they're pretty tough on which projects get the green light too, right? The sources mention strict criteria.
Oh, very strict. Technical costs have to be under $20 a barrel, and the break-even needs to be below $30 a barrel. That discipline is what helps ensure these new barrels stay accretive, for the long haul.
Right, keeps the quality high.
And that discipline, it kind of builds long-term comfort strategically. Because if you look out towards, say, 2030, over 95% of the production they expect by then, it's either already pumping or it's under construction right now.
95% locked in.
Yeah. And maybe even more importantly, most of these big projects are secured under lump sum EPC contracts.
Okay, EPC, engineering, procurement, construction. But lump sum, what does that mean for the listener? Why is that important?
It means the price is fixed up front. They agree on a total cost with the contractor, and that's it. Which is huge because it basically shields them from the kind of cost inflation that's hammered, well, almost everyone else in the sector on big projects lately. It really de-risks the execution.
Got it. So less budget blowouts. And we saw progress this quarter too, right? Like first oil in Angola.
Yep, Begonia and Silavi Phase 3 in Angola started producing. And they also sanctioned Phase 2 of the Ratawi redevelopment over in Iraq. And those Iraqi barrels, they specifically called them out as contributing and accretive.
Which is interesting given, past questions about margins in Iraq sometimes.
Exactly. Shows they're making it work there too.
Okay, so that's the upstream engine. Let's move to pillar two then. The downstream and integrated side. This is where that integration model really gets tested, right?
Absolutely. And it really showed its value this quarter.
Yeah.
The downstream business that's refining and marketing was incredibly resilient. Cash flow there was up by almost $500 million compared to last year.
500 million. Wow. And the refining part specifically seemed to bounce back hard. that European refining marker they track, it spiked.
Spiked is right. Jumped to $63 per ton. That's nearly an 80% jump just from Q2. Huge improvement.
80%. How did they manage to grab that much upside? Was it just luck?
Well, it was partly good timing, sure, but also good operations.
Yeah.
That spike was linked to tightness in the global diesel market, really low inventories. But because their refineries had really good availability, they were running well, they could actually capture those fat margins, even with some turnarounds planned later.
Right. So they were ready when the market turned. They expect utilization to dip a bit in Q4, though, because of maintenance.
They flagged that, expecting 80 to 84% utilization because of planned work at places like Antwerp and Zeetorp. But, the other side of downstream marketing and services, that delivered pretty consistent results too.
Wow.
By really sticking to this value over volume idea, they focused on getting better unit margins rather than just pushing more gallons. Smart play in a volatile market.
Okay. Now shifting sideways a bit, LNG, integrated LNG. Sales volumes were flat, I saw,
Right.
about 10.4 million tons.
Yeah, flat quarter on quarter, mostly due to planned maintenance like turnarounds at Ichthys LNG in Australia, which impacted their equity production. But strategically, they're making some big moves to secure future growth.
Especially in the U.S., it looks like. The final investment decision, the FID, on Rio Grande LNG Train 4 in Texas, that sounds important. What does an FID really signal?
Oh, it's a major milestone. An FID means they're officially committing the big capital. They're starting construction. It says, okay, this project is real. It's happening. And alongside that, they also bought a 49% stake in some shale gas assets in the Anadarko Basin, also in the U.S.
Right, locking in the supply side, too.
Exactly. Bolstering that long-term supply for their LNG plants.
We should probably mention the price they expect to get for LNG in Q4, though. It seemed a bit low, around $8.50 per MMBtu.
Yeah, and MMBtu, for anyone wondering, that's just the standard energy unit for gas million British thermal units.
Yeah.
That $8.50 reflects the lag effect, LNG prices often follow oil and gas prices with a delay of like 3 to 6 months.
Oh, okay.
So they're selling now based on somewhat older, lower prices, even though if you look at forward prices in Europe for this winter, they're still up around $11 per MMBtu.
Yeah.
That's just how those contracts work. Got it. Okay, and the last piece of this integrated puzzle, integrated power. They position this as being outside the usual oil cycles. How did it do?
Pretty well. Net power generation was up 9% just from Q2 to 12.6 terawatt hours. And what's interesting is their model seems validated. Their physical assets, renewables, gas plants, and their sales and trading activities, they contributed pretty much equally to the results in Q3.
So it's not just about building wind farms, it's the whole value chain.
Right. And they're also pretty clever about valorizing the portfolio, as they put it, capital recycling.
What does that mean in practice?
Well, this quarter, they sold 50% stakes in two big renewable portfolios, one in North America, one in France. That brought in $1.5 billion in cash combined.
But they sold half. Doesn't that mean less control?
But crucially, they kept the other 50% and they kept operatorship. So they cashed in half the value now, probably at a good price, without actually giving up strategic control or the day-to-day running of the assets.
Smart.
Okay, that is smart. But let's throw in a reality check here. Important for you, the listener. Their capacity is going fast, right? Gross power capacity up 34% year on year. But their return metric, ROACE, was only 8.6% for the last year.
Right. ROAC, return on average capital employed. It's basically their efficiency score. The target is 12%. So yeah, 8.6% looks low.
So why is it low if things are going well?
Well, a big part of it is just timing. They have this massive pipeline of projects, renewables, gas plants that are still under construction. They're spending the capital now, but those assets aren't generating revenue yet. So that capital is weighing down the return calculation temporarily. It should improve as those projects come online.
Right, makes sense. Okay, let's shift gears a bit. Future growth. And they're putting serious money into digital transformation. This isn't just about cutting costs, is it? They see AI and data as a way to actually make more money.
Oh, absolutely. This looks like a core part of their long-term strategy. The total investment is pretty substantial. Over $350 million committed to new data platforms, industrial AI. They've got big partnerships with firms like Cognite and Emerson.
$350 million. That's a big bet. And the goal I read is literally to produce 1% more of all oil fields and refineries using these advanced tools.
Yeah, 1%. Which, might not sound like a lot at first glance.
But scale that up.
Yeah.
Across their entire global operation, refineries, oil fields, that's potentially an enormous amount of extra barrels, extra product, right? For relatively low ongoing cost once the systems are in.
Exactly. It's kind of the ultimate efficiency play, high leverage. Meanwhile, on the more traditional corporate finance side, they're keeping shareholders in mind.
Right, the dividend and buybacks.
Yep. The board approved another dividend increase, the third interim one, up almost 7.6% compared to last year in euro terms. And they authorized up to $1.5 billion in share buybacks for Q4. Keeps the payout ratio around 56%, which is pretty consistent.
And the balance sheet looks healthier too. Gearing, that debt-to-equity ratio, improved to 17.3%, and they expect it to fall further.
Yeah, forecasting it down to maybe 15 or 16% by the end of the year.
Okay.
So it's getting stronger. But we do need to touch on the political climate, particularly in France. There's some, let's call it fiscal creativity being discussed.
Right, that's a polite way to put it. Political instability, talk of new taxes, maybe a super tax on big companies, or even taxing share buybacks. That must create some uncertainty.
It does. But the CEO's response on the call was, well, pretty measured but direct.
What did he say?
Essentially, he expressed trust that the government would land on something reasonable. But he also made a point of highlighting the economic reality. Something like 90 to 95% of the company's actual cash flows are generated outside of France anyway.
A gentle reminder of where the money comes from.
Pretty much.
Yeah.
And that ties into another key point they made about financial discipline. They were very clear. If cash flow comes in stronger than expected, say from higher prices or better performance.
Yeah, more buybacks.
No. The first priority for that extra cash will be the balance sheet. Continuing to pay down debt, strengthen that foundation. Not necessarily boosting buybacks beyond what they've already guided. It signals a focus on stability above all else right now.
Fortress balance sheet first. Okay. And one last thing, a structural change, mainly for U.S. investors. They're getting rid of the ADR program.
That's right, ADRs, American Depository Receipts. They're basically certificates that make it easier for U.S. folks to trade shares of foreign companies. They're terminating that program.
So what happens instead?
Their ordinary shares, the same ones traded in Europe, will start trading directly on the New York Stock Exchange, expected from December 8th this year.
And the benefit of that is?
Well, it creates just one single class of stock, simplifying things, and it means much longer continuous trading hours, effectively from the Paris open at 9 a.m. right through to the New York close at 4 p.m. The company seems to think this change can be a positive catalyst for the stock heading into 2026.
Okay, so wrapping this up. Q3 really seems to show that strategy, those two pillars, are really working now. It's not just theory.
Yeah, absolutely. It's clearly in motion, as they put it. It's translating directly into more cash flow, better resilience. Even with those external pressures like lower Brent prices, it's quite a demonstration.
And looking ahead to Q4, the signals seem pretty positive too. Continued strong production growth, investments actually decreasing slightly, and that balance sheet getting even stronger, aiming for that 15–16% gearing. They seem to be building these structural buffers against volatility.
Whether that volatility comes from prices or politics, yeah. It's a strong statement, really, about how a focused, disciplined, integrated strategy can card out stability even when the market's pretty chaotic.
Right. Okay, let's leave you with a final thought to chew on. They're spending $350 million on AI to squeeze out that extra 1% of efficiency from everything, wells, refineries, the lot. Now, thinking about all the pressures, political risks around taxes, that fierce competition, especially in Europe. Where do you think that 1% digital edge will ultimately deliver the biggest long-term competitive advantage? Is it in the high-tech, high-cost world of finding and producing oil? Or is it actually in the super high-volume, thin-margin, cutthroat world of refining, logistics, and selling the final product? Something to think about.